Hello and welcome to the Monday, December 16th, 2019 edition of Tesla Daily, unofficial Tesla podcast. My name is Rob Maurer. Today we're talking about the news on tariffs. We have some updates from analysts on Tesla stock. And then we have a little bit to talk about with the EV tax credit situation, as I think that was influencing the stock a bit today as well. As I'm sure we're all aware, Tesla stock on the day today did finish up 6.5% to $381.50. That is the fourth highest all-time close for the stock price, and it's the highest all-time close for the market cap. So the valuation of Tesla has never been higher. The macro environment was strong, but obviously not as strong as Tesla. The Nasdaq finished up 0.9%. If you are curious, the all-time high close for Tesla stock was $385 per share back in September of 2017, so more than 2 years ago, and the all-time high intraday stock price was $389.61. So 2.13% is the magic number for tomorrow. If Tesla can be up that far, it will set a new intraday high. As for why the stock was up so much today, I think it was a combination of four things. Those three things that I mentioned in the intro: tariffs, some positive commentary from analysts, and then the EV tax credit situation that we'll go into detail on. And the fourth thing, just the overall trend of Tesla. And then maybe lump short covering into that last piece on trend. All right, so let's start off with the tariff situation because I think that had the biggest impact on the overall market today. There were some deadlines looming over this weekend that sparked some progress on a quote-unquote phase one trade deal agreement between the US and China. So that started developing on Friday, and then more details came out over the weekend and helped the overall markets rise today. In terms of the US's side of this phase one agreement, the US was supposed to implement a 15% tariff on $160 billion of mostly electronics and clothing on Sunday. That tariff has been suspended. The US also cut a 15% tariff on $120 billion of imports, which began on September 1st. They cut those in half from 15% to 7.5%. And then a 25% tariff remains on $250 billion of goods. From China's end, they suspended retaliatory tariffs, which included a 25% tariff on US autos. Now, remember that 25% was an additional 25% tariff that China had applied. So this just brings us back down to the original 15% tariff. That still remains. But good news for US automakers nonetheless. Apparently, China has also agreed to increase their purchases from the United States in general by about $200 billion, which would nearly double the US-China exports in an effort to reduce the trade deficit the US has with China. And that is according to the US Trade Representative Robert Lighthizer. There have also been apparently some agreements reached on some legal intellectual property protections, but we don't actually have the full documents for these tariffs yet, so we don't know really how meaningful those may or may not be. So overall, the markets I think are taking this as a sign of de-escalation in the trade war, which then increases the probability of further agreements and possible resolutions moving forward, which of course the market likes as the indexes sit at all-time highs. Certainly Tesla has been outperforming, but that has been a tailwind for the stock. I mentioned the auto tariff thing, so just to point out how the other automakers performed today, it's not like it was just automakers doing exceedingly well today. So GM, Ford, and Fiat Chrysler were all up today, but only 1.3 to 1.8%, so not as significant of moves as Tesla, obviously. Uber and Lyft were actually closer in performance, specifically Uber, which was up 5.5%, with Lyft up 2.5%. So that carries into the next point that not all of this was just tariff or macro related. We did also have some positive commentary from analysts that have been more neutral or bearish on Tesla. So the first was from Credit Suisse, who recently did a Gigafactory tour. They're pretty bearish. They've got an underperform rating on Tesla and a $200 price target. So their analyst, Dan Levy, said, quote, "While we hold an underperform rating on Tesla, we nevertheless believe it's important to give Tesla its credit where due. We believe Tesla is leading in the areas that will likely define the future of car making, software, and electrification," end quote. He also added, quote, "Tesla is likely ahead of others on batteries, the core of the electric powertrain," end quote. So interesting comments to be so bearish on the stock. I think I learned a lot in my conversation with Alex that there's more going on behind the scenes here in terms of what analysts are discussing and researching than what comes through with just the price target or the rating. But obviously those comments seem pretty incongruent with their rating. But hey, maybe that's just something that we need to keep an eye on then, because maybe that indicates that there will be an impending upgrade to their price target based on some of their reevaluation. Hopefully someday we just get to the point where we can go direct to all these analysts and get a little bit more detail when comments like this happen. I'll definitely keep working towards that. So the second comment was from Wedbush Securities Managing Director of Equity Research, Daniel Ives, and he was on CNBC discussing tech stocks in general, saying they see about 5 to 7% of upside due to the tariff situation. And the host asked about his thoughts on Tesla, and he said, quote, "Right now, if you look at just the underlying production numbers that could come out of China and demand, as well as in Europe, I would be the first one to say, you've got to give all the credit to Musk and Tesla. They've proved many wrong, including us, that there was a near-term issue, and I think right now you are seeing the shorts go into hibernation mode until they can prove that there's another issue. But for right now, I think you will see the stock continue to go up in a short squeeze." End quote. We've talked about short squeeze a lot. I don't think this is a short squeeze type of situation. Maybe a short covering rally. I much prefer that term. Short squeeze to me means something like what we've seen with VW and Porsche, or with dry ships more recently, where it's this really sudden spike and very dramatic, versus, if shorts are covering slowly and more methodically, the stock price is probably going to increase because of the reduced share count. And there's probably fundamental reasons underlying for the stock to be going up during a period of time like that anyway. And then that rising share price causes more shorts to either want to or have to cover. And then it's sort of a feedback loop that causes further price appreciation. So I guess you could call that a short squeeze if you want to. It's kind of semantics here. But to me, a short squeeze would be more of a situation where you have this really, really fast price increase because of some other factor that's happening, where brokers are literally forcefully requiring shorts to cover their positions. These small 2 to 6% price increases are not situations like that. I think pretty much any short could get out at any time that they want to now. Yeah, it might cause the price to go up quite a bit. But in a situation like that, that covering from one short isn't going to mean that another short gets a call from their broker demanding that they cover. It's just not sudden enough, and there are plenty of shares available to buy. Anyway, I think the comments from those analysts both today probably had a positive impact on the stock. And then the last factor, which maybe seemed like the biggest factor throughout most of the day, was the EV tax credit situation. So some background here. This week, Friday, is the deadline for a federal spending deal to get done. So with that deadline looming, obviously there's been more conversation about what might and might not be included in that final deal. So last Friday, MarketWatch put an article out that quoted Mike Carr, one of the leaders of the EV Drive Coalition that's been lobbying for EVs to Congress. And he said, quote, "Thanks to bipartisan, broad-based support, we believe the EV tax credit extension is very well positioned for enactment." End quote. Also adding, quote, "It is less a question of if it's in a tax package than if a tax package will happen at all. If there's an agreement on tax, there's a very high likelihood that the EV provision is included." End quote. So you may remember we talked about this proposal about a month ago. Essentially, it builds on the current legislation for the EV tax credit by adjusting the manufacturer cap from 200,000 vehicles to 600,000 vehicles for a slightly smaller $7,000 credit versus $7,500 at the full credit level. Then this would have had its own phase-out period, etc. So anyway, based on, I believe, that article, but maybe this was picked up in other places too, either way, it seemed like the hype was building for this throughout the weekend and into early trading today. But in the early afternoon, that story flipped and inclusion became no longer likely. Michigan's Democratic Senator Debbie Stabenow said, quote, "There has been extreme resistance from the president," end quote, in regards to the EV tax credit. Bloomberg also reported that, quote, "White House officials warned lawmakers that if they tried to expand the electric vehicle credit as part of a compromise spending bill, it could tank the measure, according to two people familiar with the matter," end quote. So you never know, but it's not looking great for an extension of the EV tax credit at this point. Obviously, that would have been a big help to Tesla in the short term. That could have allowed them to capture a lot more margin over the next couple of years. It would have definitely facilitated higher take rates for options like paint, wheels, full self-driving as people stretched their budget more because of that tax credit. And then, of course, depending on how demand and production look over the next couple of years, it's possible that it could have helped Tesla sell more vehicles too. But I think the per manufacturer system, in terms of how the credits begin to phase out, is somewhat of a flawed concept If this had been put in place, Tesla would again just end up in the same situation that they're in now, where they don't have a tax credit and other automakers do. And this probably would have made that the case for a longer period of time. It also doesn't really incentivize automakers to move quickly on electric vehicles because they've got that federal tax credit there available to them regardless of what any of their competitors do. So I think even from an electric vehicle adoption perspective, it's pretty inherently flawed. And while it probably does help electric vehicle adoption happen more quickly, I don't know that the impact is really all that much. That incentive could tend to act as a bit of a safety net, encouraging automakers to move more slowly, more carefully, and more quote-unquote profitably in the short term. Now, the problem with a different system that's not per manufacturer is then you may have one manufacturer that takes advantage of those credits and accumulates all of those credits and then uses that to build an insurmountable lead that the other automakers can no longer come back from. So this per manufacturer cap does offset that aspect somewhat, which I do think is important, despite the fact that Tesla seems to be on that path anyway. But imagine the pushback there would be against Tesla if Tesla took all these credits and then got to scale and then put, GM, Ford, Fiat Chrysler all out of business. People would be pretty enraged about how those credits ended up being distributed. So I think a more ideal incentive system would be a balance between the two, where there's maybe some per manufacturer credit, and then maybe there's a time-based element where that expires after a certain period of time, regardless of production, or where there's, a separate pool of credits that can be captured by anybody. So maybe the credit extension doesn't end up making it this time, but maybe that'll facilitate a better bill making it next time. Either way, definitely something to keep an eye on this week because things can change quickly. Before the news came out that it was unlikely to be included, I did spend a lot of time going through the actual document to better understand it because there was some debate online about whether that $7,000 credit would apply to vehicles sold from Tesla this year during the old phase-out period. My understanding, and I'm pretty confident in this, is that it would not, and I won't go into as much detail here as I had planned to because it may not end up being important. But basically what it boils down to is that this new proposal is written in 3 subsections, A, B, and C. And subsection A really has the meat of the extension, the phase-out period, and all the new details. And then subsection C has the effective dates. In subsection C, it says, quote, limitation. The amendment made by subsection A shall apply to vehicles sold after the date of the enactment of this act, end quote. So to me, that means that all of the details in subsection A, which again is all of the details, quote, apply to vehicles sold after the date of the enactment of this act, end quote, implying that if it was before this act, it is not relevant to subsection A, which has those details. So always impossible that I'm misinterpreting something. This is certainly not the most easy to follow process, but I did want to at least mention it so it wasn't a complete waste of my time, and maybe it'll come back to be important. 2 other quick things. Robinhood, the online brokerage service, has announced that they'll start offering the buying and selling of fractional shares. So I've actually gotten that question from a couple of listeners wanting to invest for their kids or things like that, but maybe not wanting to buy a full $380 share. And then obviously Tesla is quite popular amongst the younger demographics, as I would expect is Robinhood. So I think this will probably open up some more interest in Tesla to some of those younger groups. Won't be anything material to the stock, but I thought it was kind of neat and worth mentioning. And then the last thing is that a few of you have reached out and asked if there is a way to support the podcast that isn't via Patreon. That's definitely my preference because I do need recurring revenue to kind of keep this going, obviously. But I also totally understand that desire. So, as many of you know, I've been working to expand on video, and that is quite costly. Just in the last couple of months, I've spent almost $5,000 building out sort of video production equipment. High quality production is important to me, and I think it helps unlock things, but it is expensive, and I still have quite a bit of a ways to go. So, back to the main point here, I have shamelessly created an Amazon wish list with some of the equipment that I need on there. So if you want to help me accelerate my investment into that space and hopefully put out better and better content, all of the things on there will directly help me do that. So if you are in the holiday spirit and want to help support that, but Patreon isn't really your style, you can find the link to that wish list in the show notes. That'll do it for today then. Again, 2.13% tomorrow. If we hit that, Tesla will have reached a new all-time high. As always, thank you for listening. I'd also encourage you to follow me on Twitter at Tesla Podcast. If you have questions or feedback, you can send those to me at tesladailypodcast@gmail.com. And if you want to support the podcast, check out the wishlist or patreon.com/tesladailypodcast. Don't forget to subscribe, and I'll see you tomorrow for the Tuesday, December 17th episode of Tesla Daily. Thank you.